Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that recently announced fourth quarter 2022 earnings, and that stock is Netflix. And we can see over the last year, their stock is down around 11% in the same time period that the S&P 500 is down around 7%. So they are underperforming the market over the last year. And we can see over the 5-year chart, they are also underperforming the market. Market's up around 54% and Netflix is only up around 37%. And so in this video, I'm just going to see if they present a good buying opportunity, seeing as they have tumbled quite a bit from their all-time highs here. I'm also going to look at some of the recent news that came out surrounding Netflix, and then I'm going to figure out the intrinsic value for the company and compare them against some of the other companies that we've covered on this channel. And so right here on this article, you can see they point out that Netflix is basically going to try to do away with password sharing as a part of their business model. And so in particular, they point out that it's going to come by sometime in March. And one of the main targets for this implementation is to stop college kids from using their families' at-home logins while they are on campus. And they've also already implemented some sort of trial for this password sharing limitation in Latin America as well. And so if I scroll down right here, we can see they point out that they're going to start cracking down on password sharing. And in a quick little post that was picked up by the press, they indicated that the way they're going to potentially be doing this is by making it so that users watching from an account's non-primary location could receive a temporary code to verify use only up for 7 days maximum to cover legitimate account user travel. So like if someone was flying, using an airplane, using their account or something. But beyond that, they wouldn't be able to use their account unless they were using their Netflix account from their primary location. In this second paragraph, they point out that they estimate that around 100 million plus households for the company share passwords, which makes up around 40% of the company's 231 million paid memberships. So if they were able to limit password sharing, this would obviously potentially open up their income statement to incur a much larger percentage of revenues, because everyone who is currently password sharing would then have to go and subscribe using their own money on their own account, and that would obviously increase Netflix's revenues. And we can see at the end here, they point out that in the beginning, Netflix's primary goal was to get people addicted to streaming. And one of the ways they did that was to encourage people to essentially share passwords so that they could get their brand out there faster. But they're basically changing their business model. Those days are over. Now that they've established a foothold in the market as a strong streaming platform, they're going to try to limit password sharing so that they can increase their revenues by getting everyone on their own account. And so right here, we can see their income statement for the fourth quarter and also for the full year of 2022 compared to 2021. We can see that revenues year over year for the fourth quarter increased from $7.7 billion to $7.8 billion. We can also see that for 2022, revenues increased from $29 billion to around $31.6 billion. So that is pretty impressive revenue growth there, around $2 billion. And year over year for the fourth quarter, it's up around 2%, so not too crazy. But unfortunately, we can see that at the bottom here, net income took a big hit from around $607 million to only $55 million year over year in the fourth quarter. So that is a massive decrease, and then it also decreased by almost $1 billion year over year from 2021 to 2022, from around $5.1 billion to $4.49 billion. And so right here, if we scroll down, we can see their balance sheet comparing December 2021 to December 2022. And during that time period, total assets have basically increased from $44.5 billion to $48.5 billion. And we can see retained earnings increased a lot from $12.6 billion to $17.1 billion. So that definitely gives them a lot more capital that they can use to distribute to shareholders and reinvest back into the company. And then lastly, right here for their cash flow statement, we can see they're comparing the fourth quarter results as well as the full year results. And during that time period in the fourth quarter, their net cash from operating activities increased from net cash used of $400 million to net cash provided by operating activities of around $400 million as well. So an increase of around $800 million there year over year. And then from their full year results, we can see operating cash flow increased from $300 million to $2 billion. So they probably didn't spend as much money this year on whatever it was that they're using to invest in their company. And so as a result, they ended up having greater positive cash flows this year than the previous year, even though we saw that year over year, their net income actually decreased. And then right here in their financing activities, we can see they did not repurchase any stock in 2022. Only in 2021, they repurchased around $600 million worth of common stock, but they did not return any value back to shareholders in 2022. And that, coupled with the fact that over the last year, Netflix's stock is down quite a bit. It has recovered quite a bit as well. They were down around 50% at one point in May, but now they're only down around 11%. So that is good news. But that being said, the decrease in the stock price, coupled with the fact that Netflix hasn't really made an attempt to return value back to shareholders over the last year, is definitely a Debbie Downer for some shareholders of Netflix who were holding onto shares this past year. And so now we can see a discounted cash flow model trying to figure out the intrinsic value for Netflix here. Yahoo Finance is estimating that this company is going to grow at around 15% for the next 5 years, compounded annually. They had around $1.6 billion worth of free cash flow in their last full year, around a $10 billion net debt position on their balance sheet, and around 445 million shares outstanding, which unfortunately puts their intrinsic value per share only at $48 per share, which, considering the fact that they're trading at $347 per share, that would mean that based on these projected growth rates, Netflix is currently pretty heavily overvalued relative to their intrinsic value. And so on the right-hand side here, I compared them to some other streaming companies or companies that provide streaming services in their industry, Amazon and Disney. We can see that in comparison, Amazon was actually not profitable over the last year, so they don't have any net profit margin or return on assets, but Netflix was. They had gross profit of 39%, net profit of 14%, return on assets of 9%, and PE ratio of 35. All of those numbers beat out their competitor here, Disney, and none of the companies really paid out a dividend. So from this competitor analysis, it would seem like Netflix is doing better than Amazon and Disney in terms of financial ratios. But obviously for Amazon and Disney, these companies have other products and services that they sell aside from just streaming. So it might not be the best analysis to make in terms of comparing their streaming services against one another, because Netflix is solely a streaming service, whereas Amazon and Disney have streaming services, but they also have a lot of other products that they sell to customers. And so on the right-hand side here, I compared them to some of the other companies we've recently covered. We can see that in terms of share price compared to intrinsic value, Netflix is coming in dead last at the moment over the last 5 videos we've covered. Their share price is currently trading at 7.18 times their intrinsic value per share, given that it's $48 per share and they're currently trading at $347 per share. So that puts them dead last behind Albertsons, Accenture, Adobe, and Nike. Albertsons, the stock we covered in the last video, being the best at around 0.45 times their intrinsic value. So they're the only company on the list so far to be trading below intrinsic value per share. In terms of growth rate, Netflix actually had the highest growth rate projected at around almost 16%. So considering they had the highest projected growth rate and they had the worst share price to intrinsic value, it definitely is not a good sign. It could mean that they're trading at an even worse buying opportunity than could be initially estimated just based on this table alone. In terms of profitability ratios, we can see Netflix is actually doing pretty good relative to the other companies we've covered. They had a gross profit margin of around 39% and a net profit margin of around 14%. Adobe is still holding the #1 spot for profitability margins. And then lastly, for stock market performance, we can see Netflix is up only around 37% over the last 5 years, whereas Adobe is still holding the #1 spot at around 96% over the last 5 years. So in terms of comparing them to the other companies we've looked at, they're probably not doing that good, especially if we look at this intrinsic value table right here. It looks like Albertsons would still present the best buying opportunity over the last 5 companies we've covered. In terms of a competitor analysis perspective, it's kind of difficult to compare Netflix against Amazon and Disney because they provide other products and services aside from just streaming. But based on these financial ratios, Netflix is beating out Amazon and Disney. And we can see from an intrinsic value standpoint, they're definitely not trading below intrinsic value per share based on these estimated growth rates of around 15 to 7% over the next decade. So Based on this information, I'm not exactly too sure what to make of Netflix. I probably personally wouldn't buy into it myself, but let me know in the comment section down below what you guys think of Netflix. Is it a good buy right now, or are you still going to wait to see where it goes from here? Let me know what you guys think. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.